Now let's welcome my special guest, Matthew Johnson, the owner and president of Johnson Wealth and Income Management, all the way from Iowa. He's been an advisor for more than 15 years. Matthew, thanks for joining us today on The Income Generation. It's great to see you.
It's a pleasure, sir. Glad to be back.
Glad you could sit in on the show today. You know, I've known you for a long time. You're a special man. I know you've got some unique talents and understanding what's happening in the markets and the economy. But tell us, based on the topics of today's show, how do you feel about the macro data, the large economic data, the potential for recession? What are you seeing in Iowa, and what are your thoughts?
Well, recessions are really important, and it's important to be able to spot a recession. But we know that we have recessions and recoveries that take place not only in secular bull markets, but also secular bear markets. But one of the bigger concerns that I have is really this. The government's not talking about this. Wall Street's not talking about this. The financial services industry isn't talking about this. The recession that I am most concerned about is the personal recession that's going to start happening to the baby boomer generation, the income generation. We call them the sandwich generation for a reason. They've put their kids through college, they're taking care of their parents, and they're hitting retirement, showing up with less savings and less money than they expected to have. Well, that could create a real recession, because if you show up on retirement's doorstep and you don't have the cash, you don't have the money to be able to retire, or what you think it's going to take to retire, all of a sudden you're going to start spending less. You're not going to be buying the luxury items. You're not going to be buying the cars and, you know, that second home in Florida. It could create a real slowdown, but it's the reverse wealth effect, isn't it, that we're seeing?
It really is, and I like your terminology, personal recession, because a slowdown in the markets, a slowdown in interest rates affects the amount of money people are going to have. I think on the personal recession bit, with the market being at its all-time peaks again, it's going to be very hard for people to get economic expansion. So how do we deal with that, MJ? How do we overcome that?
Well, there's two ways that you get income when you're retired. You're either going to take and you're going to be selling assets, you're going to be selling shares, right? You're going to be selling things away in order to get money in exchange. Now, if the market stays high, that's not going to be a big deal, but we know that the market's not static. It doesn't always continue in one direction and go up. So what we've got to be able to do is we've got to make that transitional shift from income by selling now to income from interest and
Hold that thought. Matthew Johnson, don't go away. We'll be back with more here on The Income Generation right after the break. Welcome back. We're talking with Matthew Johnson, the owner and president of Johnson Wealth Management in Iowa. Matthew, thanks for sticking around.
Thanks so much, Steph.
You know, in our last segment, we were talking about the personal recession and the market being at the top end of the range and how people can actually get more growth. So why don't you keep the dialogue going on what you were digressing into about how people overcome the fact that they need growth in their portfolios, in their money, so they have a healthy retirement and they can create income. What should an investor do today in that scenario?
Sure. Well, the formula is really simple. Everybody wants total return. Everybody wants to grow the money, but we must understand that there's a couple of different ways that you can grow your money. You could go out and you could buy a stock and you can cross your fingers and toes in hopes that that stock goes up, right? But what if you started focusing on growing your money the old-fashioned way through interest and dividends? This is the old technology that the generation that lost everything to, you know, the Great Correction of 1929 learned over the course of 25 years. They learned that if their dollar earns them $1 of dividend, that's $1 of growth, right? So the idea of income production through my savings, if I'm able to take my savings and I'm able to invest it in such a way where I get interest and dividends steadily, very reliably, month after month, it's income that helps people successfully retire. The number one fear today when I meet with my clients is no longer that of dying. It's running out of money. And how do you run out of money? You run out of money by having to sell assets. And when those assets run out, you're done.
So you end up cannibalizing the resources.
Exactly. You're selling more and more assets and just hoping and crossing your fingers and toes that the market's going to continue to go up. What if your principal could remain intact? What if your principal could now generate interest and dividends, and you could do what your parents and grandparents tried to teach you how to do, and that's to live off from the principal instead of on the principal. This is what I'm teaching my clients. This is what I'm seeing is the coming recession. People are, their advisors are not teaching them how to create income with what they've saved.
That's really a fundamental shift that investors have to make then to get out of the personal recession mode and the cannibalization of the resource when they decide to create income from their portfolio while they retire in their 60s, 70s, or 80s. And so what are some of the things that investors want to do today in your neck of the woods in Iowa? How are they feeling about the markets? They feel good? Are they optimistic? Are they pessimistic? Or is their radar spot on? How are investors feeling in Iowa right now?
Oh, there's a lot of different emotions. On one hand, they have this inbred sense that they need to be optimistic. They want to be optimistic, but their gut instinct is telling them, you know what, the market's too high. I need to make a risk reduction. And so they're searching for answers. They're trying to figure out, how do I do that effectively? Because they know the answer is this. They know what the answer is not. They know it's not putting the money in the bank.
It's the same in Florida. I think it's universal. All right, Matthew Johnson, thanks for joining us today.